Let's look at the silver daily chart. In the last video, I walked you through the specific structure of the February 6th candle. I marked it as the definitive line in the sand. I explained the swing failure pattern developing in real time. I laid out a precise support zone between 72.6 and 70. I told you clearly, if price held that pocket and we saw displacement to the upside, 75 would print, and then 77. Silver is now trading at 75.5. The market didn't just move randomly, it followed the map. This was not a guess. It was a technical validation of liquidity zones that most retail traders ignore because they're too busy chasing green candles. If you followed the levels, you're not surprised. You're positioned. If you ignored them, you're likely chasing the move now. And that's exactly how the house wins. Most people won't finish this. They'll click away the moment the data challenges the narrative they've built in their head. They leave when the numbers stop being exciting and start being work. That's fine. This channel isn't for the majority. It's for the persistent minority who would rather be correct than comfortable. It's for people who check primary sources before forming opinions. It's for traders who understand the difference between market narrative and hard market data. If you're looking for someone to tell you silver is going to the moon tomorrow based on emotion, there are thousands of other finance channels that will gladly cater to that. Focus on verified accounts and official handles when you follow market commentary. Display names can be copied. Handles are unique. That's how you avoid scams. The people who belong in this community are the ones adding primary sources in the comments, pointing out technical nuances, and refining the discussion. That's the standard. Subscribe if you want the data. Don't if you don't. The objective here is precision, not popularity. Now let's get into the numbers. Silver Western Spot is at 75. Futures are also trading around 75. Shanghai Spot is at 86. Shanghai Futures are at 88. That is roughly an $11 east to west premium. That's not a minor discrepancy. That's a massive arbitrage window, and it tells you where physical demand actually lives. Gold Western Spot is currently 4,930. The FOMC minutes release at 2 p.m. Eastern. This is a high-impact volatility event. Expect aggressive liquidity hunts around this window. The economic calendar isn't just news. It's a schedule of when large players seek liquidity to fill positions. On lower time frames, market structure remains intact. Upside objectives remain 77, then 78.2. If buying pressure sustains, price will gravitate toward those levels. Immediate downside support sits between 74.8 and 73.9. I do not want to see a single candle body close below that range. Wicks are acceptable. That's the market testing buyers and cleaning out late longs. But a body close below 73.9 suggests momentum is shifting and the bounce is failing. The February 6th candle remains the anchor. We do not want body closures anywhere near the proximity of its wick. If we see sustained closes below 72.6 to 70, the structure breaks, and we can expect a move towards 67 or even below the February 6th lows. With FOMC minutes today, be prepared for both directions. This is not the time for bias or gambling. It's a time for observing reaction. Let price confirm before acting. This analysis is for educational purposes, specifically for short-term traders tracking intraday structure. Now let's talk about what changed overnight. The United States has developed a critical minerals price floor system and is pitching it to global allies. The objective is to reduce strategic dependence on China for key resources tied to national security. Multiple federal agencies collaborated on a structured price floor mechanism. Officials confirm discussions are underway with international partners. Pricing, they argue, unlocks private investment. When this news broke, metals surged. Gold moved $90 higher to $4,956. Silver jumped more than $3 to $75. This is not theoretical anymore. A price floor system for critical minerals, which includes silver due to its industrial and solar demand, means the government is effectively guaranteeing minimum pricing, regardless of paper market volatility. When governments guarantee floors, the paper market loses one of its strongest tools, the ability to force price below production cost to shake out participants and maintain artificial narratives. At the same time, institutional voices are shifting. Large capital allocators have warned that rising trade tensions and expanding fiscal deficits are eroding confidence in U.S. debt. The response? Increased allocation toward hard assets as structural hedges. When capital at that scale adjusts positioning, it signals broader transition, not short-term speculation. Now look at COMEX. Registered silver inventory stands at 92.2 million ounces. March open interest is 285.3 million ounces. That's roughly 193 million more ounces in paper claims than deliverable registered metal. Last Friday alone, nearly 5 million ounces were withdrawn from COMEX vaults. About 800,000 ounces shifted from registered to eligible status. Registered silver available for delivery has fallen to roughly 92 million ounces. Withdrawals are accelerating. March open interest only declined by 7.6 million ounces, from 293.9 million to 285.3 million. At this stage, the roll should be accelerating far more aggressively to reduce delivery pressure. Open interest would need to fall by roughly 30 million ounces per day to normalize positioning before delivery risk intensifies. That is not happening. The curve is tightening. Watch the structure. Watch the inventory. Watch how price reacts around macro catalysts. Let the market confirm. That's the work. The March-May spread is -52, but once financing, storage, and insurance are factored in, the carry-adjusted contango shrinks to just 4.9. In practical terms, the market is offering almost no incentive to roll positions forward into May. When the spread fails to compensate traders for carrying costs, there is little motivation to roll contracts, which creates persistent upward pressure on the nearby March contract. With only 8 days remaining until March settlement begins, this dynamic becomes even more critical. The data supporting this is publicly available on the CME website. Anyone verifying the numbers independently can see the same imbalance forming between physical demand and paper positioning. Recent earnings from Hecla Mining reinforce the broader thesis. The company reported revenue exceeding $1.4 billion, up 53% year over year. Net income reached $321.2 million, a 9-fold increase compared to the prior year. Silver production hit 17 million ounces, landing at the high end of guidance. Free cash flow surged across all operations, and total debt was reduced by 50%. This is what happens when silver prices begin to reflect actual supply and demand fundamentals, rather than paper-driven distortions. Mining companies that struggled at suppressed price levels suddenly generate record profitability when price moves closer to equilibrium. The macro backdrop adds another layer. In Currency Wars, Jim Rickards described how commodities become strategic assets during periods of geopolitical realignment. We are now witnessing that transition. Governments are securing critical mineral supply chains not purely for profit, but for national security. Strategic price floors and domestic sourcing initiatives are not free market adjustments. They are components of financial and geopolitical strategy. At the same time, geopolitical tensions remain elevated. Reports suggest the possibility of expanded conflict in the Middle East if diplomacy fails. Roughly 20% of global oil flows through the Strait of Hormuz. Any disruption there would reverberate through global manufacturing and energy supply chains, directly impacting industrial metals, including silver, which is already in its 6th consecutive year of structural deficit. Mining equities relative to global markets are sitting near 60-year lows. Historically, from 1900 to 1965, mining represented around 8% of global equities, peaking near 10% in the mid-20th century. Today, the sector represents roughly 1%. A return to long-term averages would require an 8-fold relative increase. A move back toward historical peaks would imply even greater upside. As governments reshore manufacturing and prioritize supply security over margin optimization, energy and metals shift from cyclical exposures to strategic necessities. Capital allocation begins to prioritize availability over efficiency. Charles Mackay documented in Extraordinary Popular Delusions and the Madness of Crowds how markets oscillate between extremes of neglect and euphoria. Mining at 1% of global equity weight during a time when governments are implementing strategic resource policies suggests deep pessimism at the very moment fundamentals are shifting. Technically, gold miners versus the S&P 500 appear poised to break out of a decade-long range. In 2011, gold miners traded at roughly 3 times their current relative valuation. Yet this cycle differs structurally. Central banks are net buyers of gold, and confidence in fiat systems is under sustained pressure. If this environment mirrors aspects of the 1970s, hard asset producers could significantly outperform broader equity indices. That said, risks remain. FOMC minutes could trigger volatility. Geopolitical rhetoric may de-escalate, removing risk premiums. Strategic pricing policies remain under discussion. March open interest could still roll late. COMEX registered inventories could prove sufficient if historical delivery averages persist. Capital may remain concentrated in technology and AI sectors longer than expected. However, the broader picture shows strategic policy shifts, tightening physical inventories, roll rate dislocations, improving miner profitability, and technical breakouts forming simultaneously. Silver recently held support precisely as projected and has already advanced from those levels. The structural supply deficit continues to intensify. Markets eventually reconcile paper positioning with physical constraints. When they do, repricing can be abrupt. Positioning based on structural logic rather than emotional reaction remains essential.